The Hedgeless Horseman here. It's June the 26th, 2025. First of all, thanks to the sponsors. Some are not sponsors anymore on this slide, but I just haven't had the time to take them down. Anyway, consider me biased. In this video, I thought I'd take a look on some really interesting headlines recently, which, I mean, in my opinion, just shows how wacky things have become, and why, in my opinion, the reason, or let's say, the bubble that a lot of people have been buying gold for, and for a long time, and silver and all that, and why I'm in mining stocks, etc. I mean, to me, it just looks like it's getting bigger and bigger and bigger, which I guess shouldn't be that unusual, because, I mean, nobody in power, let's say, wants the system to go down, and as long as there's appetite for risk and rates are low, etc., etc., markets and humans, as always, are going to find new ways to make money, and typically they get more and more perverse the longer it continues. I mean, in the going into the end of the Weimar Republic, for example, before that blew up and they had hyperinflation, people became a lot more speculative, and I think some of the stuff we're about to see is testament to that in fact, it's getting worse and worse in a sense. And why I personally am getting happier and happier about owning finite real assets that you cannot print, that you cannot copy, that is not artificial. Limited supply. Anyway, first of all, let's look at the markets. Markets appears to be up. Copper is breaking through. Oh, excuse me. Copper is breaking through $5 at the moment. Of course, could go down tomorrow. I have no idea. Silver bounced back, not far off from $37 again. Gold hanging in there. I think it was up earlier today. Well, up a bit and then down a bit, and yeah, basically neutral. Crypto going nowhere. Anyway, let's look at some very interesting headlines. So this came out yesterday. Fannie Mae and Freddie Mac are preparing to count crypto as assets for mortgages. I mean, to me, this is absolutely crazy. But yeah, I mean, there's a lot of speculation that Tether, for example, I guess in combination with Bitcoin, is kind of used to prop up the US treasury market, which would not be totally surprising given how much focus Bitcoin, etc., has been given by the current administration. Not that there's been a strategic Bitcoin fund, as far as I can tell. But hey, I mean, if you have a vested interest in getting money to whatever, have Tether buy up a bunch of US treasuries, of course that helps a country which is now, I think, printed a record deficit of like $450 billion or something. I'm talking about the US, of course. So, I mean, the finances in the US are getting worse and worse. And obviously you don't want, if you're adding on more debt, you don't really want the rate on that debt to go up. So if you can use whatever Bitcoin Tether to help that out, I think it's in their interest to do so. And that's also a problem. Well, that ties into this. I mean, if they're going to count crypto as asset for mortgages, as far as I understand, the housing market in the US is not feeling that well right now, and that's typically what governments do, right? They try to help out they don't want asset prices to go down, of course. I mean, in Sweden, for example, we recently, I don't think it's, well, our central bank lowered rates, and I think that there's it's been tabled a proposition or whatever you would call it that would allow people to borrow even more. Now I think you have to have like 15% down payment for a mortgage. That's the minimum. I think they're gonna reduce that, or the suggestion is to reduce it to 10. Meaning it's like you're leveraging up the system even more, right? That people can borrow more. What does that mean? Well, more money gets created, housing prices might, start to go up again, and you have that, vicious or perfect cycle of asset prices going up, so people can borrow even more to, push up other asset prices. I mean, in Sweden, for example, especially in Stockholm, if you've been highly levered in the housing market for the last 10-15 years, you probably have had your equity go up much more from that than your combined savings, let's say, from working. That's basically, I discussed this with a friend recently. I mean, I don't think it's unique for Sweden, but if you want to create wealth, if you want to get rich, you won't do it from working, let's say, in Sweden. Taxes are too high. Obviously, inflation is up quite a bit, probably a lot more than the official numbers. It takes forever for people to save up $100,000, for example. But houses, I mean, yeah, the more levered you've been, kind of the better. And coming back to this then, okay, let's say you have a bunch of people tied up into crypto, and as some of the Bitcoin maxis suggest, you should never sell, yada yada. Well, then you have, let's say, capital stuck in Bitcoin, or or if they don't want necessarily crypto to go down, for example, especially if Tether and Bitcoin is in fact helping with the increasingly worse debt situation for the US. Well, okay, how do you, help that situation? Well, I guess give people the option not needing to sell crypto for fiat to put into a mortgage. If they can just have the crypto on the books, for example, and they can leverage that, well, all of a sudden you're creating also even more money, right? Even more fiat, without anybody having to sell anything. You're just leveraging up. Basically, you're able to put leverage on a financial asset such as crypto. But of course, I mean, it's like there's been quite a few jokes about this. I mean, I've been laughing my ass off to some of these. Like if Fortcoin dips below 80 cents, the entire housing market collapses. And of course, this is a snapshot from the movie The Big Short. And I've seen other comments like, hey, this is gonna, the next housing bubble, when the next housing bubble bursts is gonna make 2008 look like a bull market. Because I mean, imagine having, I mean, this hasn't even started, but imagine having mortgages, etc., underpinned by crypto. In a lot of people's eyes, long-term worthless, and if not that, at least it's like super volatile. I mean, the average Bitcoin bear has been what, minus 70%? So, I mean, it's just crazy, and that's Bitcoin. I mean, other stuff is probably even more volatile. So I have no idea how this is going to end good. that your collateral for your collateral and what you leverage off of are artificial digital tokens. It's absolutely crazy. It's like putting leverage on the fact of nothing except, let's say, confidence or whatever. So I mean, it's like, Jesus, you see stuff like this and so, oh yeah, I mean, I'm starting to like my gold even more. And of course, I don't know what's gonna play out, but in my opinion, this is just again symptom of a bubble. And it looks like, okay, how if we have a bad situation, that situation, yada yada. Of course, everybody's going to try to kick it down the road, kick the can down the road. So this looks like one way to do that, which means that, hey, this farce of a financial system might, on paper, keep working until whatever comes next. The bigger the party, the bigger the hangover. And of course, I don't get FOMO from this. It's like, yeah, can Bitcoin go up? Of course it can go up. I'm more interested in what happens after all the stuff we're seeing now, when the chickens come home to roost. It's like, what's going to happen in the aftermath? Because this obviously can't continue forever. And this as well. Canary Capital files for first ETF including Pengu token and Pudgy Penguin and NFTs. I mean, I don't know if this is a big deal. Is this from March 20? I think I saw a new one, and then I just some new news about this, and then I guess found an article. But this one I found apparently is from March 20. Anyway, so this looks to be going ahead, whatever this is. First ETF including Pengu token and Pudgy Penguin NFTs. I thought NFTs were dead and buried already, but who knows? It's like the big bubble has not burst yet, and again, people are gonna find new ways to profit from it. And I mean, what they say about war is that we have new wars as soon as the generation who remember the last one dies, the horrors of the last war, right? And I mean, we see that in especially Europe. I mean, everybody thought that war was a thing in the past, which I guess happens every time there's been some, a few decades from the last war, and then, Ukraine-Russia happens, and all of a sudden everybody's like, oh crap, we are not too civilized or modern for war to actually happen. So it might be a case of that, or maybe NFTs will still be dead, but still, just to see headlines like this making the rounds on Twitter. This one I really like. I think I also saw this yesterday. From Bloomberg, a footwear startup is teaming up with 2 space companies to design a shoe in orbit as part of a mission to make artificial intelligence and blockchain less expensive and more eco-friendly than it is on Earth. And then I guess they summarize the participating players. Orbit's Edge, a company that supports AI and blockchain applications, and Copernic Space, which offers digital marketplaces for space assets, plan to send a solar and battery powered satellite to space equipped with a computer that will use AI automation to produce a shoe design for the Scintillate brand. I mean, where do you even begin? Yeah. It's like a who's who of hot catchphrases, I was gonna say. Then add, for some reason, shoe design. Like this guy says, I'm so effing done, I can't take this anymore. I mean, again, that's why it's like, I see some people, especially ones who, I think kinda semi or actually did throw in the towel at these recent lows in the mining space. I mean, they for sure did not average down over the last 12 months, for example. I mean, I I still think that the junior sector overall, especially the mining sector, that it bottomed last year. And I don't think a lot of people, like always, actually had the stomach to average down after looking at mostly probably paper losses for 3-4 years straight. Uh, which is very human, of course. That it's like there's so few that are able to do that, and that's also why there's so few that actually make any money. Even if you give them 20 years in the mining space, because they're never going to be able to buy low after they've looked down for, on average, for years on end, because that's just too much to bear. You have to be you have to really understand sentiment and cyclicality, and also be, at face value, arrogant. It's like, oh, you've been punched in the face 100 times by an opponent, and you still want to fight. That just sounds stupid, but in a cyclical sector it is in fact not stupid. It's basically the most sure way that, well, the only real way that you can somewhat predictably make money, because a cyclical sector always crashes, always goes up. So, but my point is, when I see stuff like this, it's like, my idea is that when is the real asset bull, gold, silver bull, and all that? When will we have a final top? And I'm not even saying I'm going to be, selling that, for example. There's obviously been, after the 1980s bull top, what was it, like 20 years of a bear market in the gold space. Not that you could not make money, but of course it was probably quite hard, especially if you got in at the top in 1980. But stock picking and alpha, you could still make money, in my opinion, if you learn enough and all that. Pick, whatever, have a good enough strategy. But it's like, I'm not worried about a top when I see stuff like this. I still think, we're in an end game that's just getting more and more ridiculous. Crypto underpinning mortgages, NFTs maybe making a comeback, a shoe space blockchain AI company. It's like, you couldn't come up with some of these headlines. Do you think you'll see headlines like this in a depression where it's risk off and all of a sudden, economic gravity is important? No, you see stuff like this obviously when everybody's kind of looking for excuses to buy the next hot thing, because hot things have worked. So I guess my simple point is that I'm not worried at all about needing to sell anything anytime soon in the real asset space. And maybe more importantly, it's like, what's a proper top in any market sector asset? That's euphoria. When you reach that A, stuff goes exponential. So the most of the quickest, the most of the gains, I guess, comes at the very end of a bubble. At the end of a bubble, a blow off top. Let's say. I don't see euphoric valuations in the junior mining space. That's for sure. Are there some juniors that might be overvalued? Yeah, in my eyes, sure. Especially relatively speaking. There's juniors out there that might not really be expensive. They're actually maybe cheap, but compared to some other juniors, they look super expensive. So it's like, it's not that they are necessarily sells. It's just that I think there's much better buys. So as long as there's no-brainers in the junior space, for example, I don't see me having a problem. This sector is going to be very hard when you can literally not find anything, and that you think, well, I need blue sky to work out here for this price I'm paying not to look, low or cheap. I don't want to need blue sky to be the only way for the investment to pay off. Let's say it's like, whatever, your something is priced, that I'm just making up stuff now, but it's like something is pricing in the spot gold price and a pre-resource play, and they're pricing in that they're going to find 3 million ounces already, and the blue sky is like 5 million ounces. So it's like, okay, it's pricing in the current gold price. So already they're pricing in 3 million ounces. We need to get to 5 and or an even higher gold price for that to work out. And there's no guarantee they will even have 3 million ounces, for example. That's not a risk-reward bet I like very much, because then you have no margin of safety. The upside only comes from speculation. And if not even whatever the base case turns out to be true, then you have overpaid. I mean, right now I still think you can find a bunch of juniors with they're cheap just based on whatever they already have proven. Cheap based on what they already have proven plus lower metals prices, and you get then all the exploration potential and what have you for free. That's good risk reward. I have margin of safety. The future needs to be, let's say, worse, much worse, for me to have overpaid for it today. And if that doesn't happen, and or they create even more value, then I might, get a multi-bagger. That's that I don't need to get lucky per se to make money, but I have a free option of getting lucky. That's what I like. And yeah, some comments here is like the usual, because you'll see this in basically every stock near a low. There's going to be trolls in. There's a few rooms I've seen some trolling recently, but of course trolls, when a stock is running, when it is near what later was like, let's say, a short-term or medium-term top, for example, there's nobody dares to be negative in a sense. I mean, the trolls, you won't see them typically, but when the correction comes, especially in a long correction, then the trolls feel, they don't need to be that brave, if you know what I mean. Because the recent trend is down, so they don't need a lot of balls, let's say, to talk about a lot about negativity. And of course, that's the irony of it. Like at the lows, everybody's kind of looking for excuses to sell, so the main focus is looking for an excuse to sell. So negative things will get priced in, and overly priced in at the lows, when the ironic thing is that that's already priced in, so you should be thinking about what could go right, for example. But that's not how it works in the markets, and it's very hard, of course, if you don't have. That's why conviction is so important. If you don't have your own conviction, and at lows you're going to see 90% of comments might be negative in whatever market sector, asset, stock, yada yada. So the best buying opportunities tend to come when there's overwhelming negativity, and the negative stuff that people are talking about as risks, they're already priced in, but they can't see that it is priced in, etc. So they're thinking, everybody thinks what could possibly go more wrong, let's say, even though a lot of the cases nothing has gone wrong, it's just price have gone down. But people tend to look at the share price direction as due diligence, that if the company gets cheaper or goes down in price, that means things are getting worse. And a lot of the time nothing has happened, or even in some cases things have gotten better. That's obviously where the value investing, I don't like to call it contrarian, because it's just common sense that if the company has not become worse, if the fundamentals have gone up but price has gone down, that's just a more obvious buy. And of course, if you can't buy low and lower and lower still, you came to the wrong sector. And why that is important, I mean, this is, one could look at like First Majestic or whatever. Maybe I'll get to this later, actually. Also, another thing to notice again is like, never forget that almost nobody beats the regular stock market. I've heard when you look at active funds, for example, I think it's 10% that outperform. So 1 in 10 funds actually outperform, and they have a bunch of whatever trained experts, professionals, yada yada. 1 in 10 outperforms a passive hodling index. And of course, in this sector, which is even more volatile, I think that number is higher. I think there's very, 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 very extremely few people who actually make any money in this sector over the long term. And when I say that, I mean whatever, from bottom to bottom, because you can't just look at going from here to here and judge your portfolio returns here. It's like, oh, I'm that bad, huh? Minus 50% in 3 years or something. Well, that's not accurate, because that's not a full cycle. That's only the downside of a full cycle. So you should either, of course, if you're down going from here to here, yeah, you get stuff to work at, obviously. If you're down from here to here, if you're down a lot, that might not necessarily mean you're bad at all. Going from here to here, it's impossible to lose money. That doesn't make you a great investor, right? So if we only look, if you judge yourself and your skills on what you made from here to here, your ego is going to be super inflated. You're going to think that it's so easy. Then you're going to get hit with this, while your ego is super inflated and you think it's so easy and should be easy, and this is just going to continue, up. So yeah, I mean, vast majority of people don't make any money in this sector, even if you gave them 10 years. I mean, I think the biggest problem is that nobody sticks around for that long. Most people sell here, buy here and sell there, and then new people come in, they buy here and sell there. So very, very few, I think, has the staying power and figure out how to actually make money. But you're gonna hear from 100% of people. I don't know how often people throw their, especially timing, you say something or something is in a downtrend, always their regular comeback is like, yeah, I think it's gonna go lower still. When something's going up, people are gonna say, I think it can go higher still, etc., etc. So everybody, or a lot of people, are very quick to give advice or quote advice, but it's like, to air their opinion. But statistically, it's impossible that many people actually make any money. So and I'm not meaning that people who give their opinion, I'm not saying that they're assholes or anything like that. They're intentionally trying to do something. I just mean that a lot of people, because it's so hard, tough pill to swallow. Everybody wants to believe they're doing the correct thing. Their feelings are rationalized. That's what I went through the last video about that guy. It's different this time. He obviously, he feels like he doesn't want to buy, and I don't think he bought the low. Then he uses his feelings and find rationalization to come up with why he's right. And he's not saying, in my opinion, I think he's emotional and not rational, but he doesn't really, he can't see it in a sense. So he's going to throw his opinions, which is like arguments, but they are really disguised feelings, at me, and not to whatever mess anything up or something, but he wants validation, because everybody's obviously kind of afraid of doing the wrong thing. So you kind of air your opinions, yada yada, that justifies your action or non-action, etc., etc. But yeah, to summarize, remember, and that goes for a lot of big accounts as well. That goes for a lot of people with maybe hundreds of thousands of followers, etc. Most people absolutely do not can't outperform the market or beat an index. statistics show that, again, like 1 in 10 funds do that, and 1 in 20 active investors in the regular stock market, and add the volatility in this one and the pitfalls and all that, I would say it's less than 5%. So the overwhelming majority of opinions that's going to be thrown at you comes from people who don't have good returns and probably won't have even good long-term returns. So you should not really be afraid to take a stance against the crowd, of course, because the crowd is, vast majority of the crowd make poor decisions. But that's not easy when everybody disagrees with you, etc., etc. So in a sense, you kind of have to be. I mean, I wouldn't be surprised if I come off as, arrogant at times. But I think you also, in a sense, I mean, stock picking in the first place is arrogant. You're buying something because you think the market is wrong. The all-knowing, efficient market is wrong. That's the only reason you buy something. So that's arrogant to begin with. So you have to be a bit arrogant. Because it's by definition arrogant to think you can beat the market. Because everybody says the market is, an efficient pricing machine, which I don't buy in, or at least, the whole point of stock picking is that, let's say you think something is really, really cheap. You think that nobody agrees with you, it's at a low, whatever, everybody's negative on it. The worst that can happen is that you can lose 100%. The worst. Best case, you are right, the market is wrong, the 95% are wrong, and you'll make a lot of money. That's why, as price declines in, for example, an unchanged story or whatever, the opportunity, the risk reward doesn't go up linearly, it goes up exponentially. And of course, at lows, people complain and refuse to buy. I've seen people already still bitching about the mining sector and the juniors, etc., even though, most of them are up, 100 or 200 or 300% from the 2024 lows. Not everyone, but some are, for sure are. But they're still bitching. Why would they be bitching? Because of course they did not buy going into the lows. They couldn't average down. They couldn't look at a 3-4 year long downtrend and keep adding month after month after month until the bottom was in. No. So they kind of have to doubt it, because otherwise, when you're off the lows, there's regret of not buying lows. So they just compound their frustration in a sense. Complain and refuse to buy when stuff is going down and cheaper, and you should be buying. When it goes up, they get more pain because they didn't average down. Now they have regret of not buying the lows. I'm already getting, when I look at some, let's say some cases where it's like, I think that's a no-brainer, I just don't have the money because I'm always fully invested, and I can't really, be value shifting willy-nilly because I'm a, somewhat public figure. So I am not that active anymore. Especially if I put out an article or talked about how cheap something is recently, I don't feel comfortable value shuffling, let's say. What was the point I was gonna make? Regret. So it's like, I've said this before, it's like probably 20 companies I don't even have a position in and would like to buy. Some are like, let's say super cheap, pretty much semi-no-brainers at least, and you're like, I can't wait. I'm hoping some of the other no-brainers, they perform, they revalue with good reason, and some other semi-no-brainer or even some other no-brainer has not revalued yet. Because then that's the thing, it's like, as long as we have something really, really cheap, even no-brainer cheap to invest in, and I'm not saying go all in on any one stock, but it's like, if we can find, 5 no-brainers, 15 really cheap ones, have a 20 name portfolio, for example, You don't want all of them to go up at the same time. If 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 all the no-brainers and all the super cheap ones that you can find all revalue at the same time, where are you going to put your money next? The easy money is already made in that case. And now you're hoping maybe to find something that looks maybe cheap. No, then the gravy train is unfortunately over. The easy gravy train in a sense. We always want that's why it's like having laggards is not a bad thing at all. Let's say you have 10 names. 8 of them revalue. You think 10 are cheap, super cheap, 8 of them revalue. Okay, so let's say you gain 50 to 100% and they're cheap, they're not just no-brainer cheap anymore. But the 2 other ones that you thought were also no-brainer cheap to begin with, they're still no-brainer cheap. Then they have better risk reward. Then you could value shuffle some out of the 8 names that have started to revalue by some of the other ones. That lowers that makes your portfolio cheaper and more money getting into even better risk reward. And in my opinion, you don't really need to necessarily do it in a sense, because I think there's some merit also, especially if a stock has a long pipeline or really good management. You can just fire and forget. Let the winners run, yada yada yada. But it's like you at least have the option. My point is that you don't really want everything to go from super cheap to not cheap at the same time, because then you have no higher future reward opportunity. Anyway, so yeah, and again going back to like you have to be good at buying low. I mean, I have bought every single top in the mining sector since 2015. Yeah, I got in near the lows, but my portfolio still got cut in half in the first 4 months. So even though I thought it was low, I got in around here, I think. I mean, take First Majestic. So it basically got cut in half. And looking back, one would say that, yeah, this was pretty low, right? But at the time, when you were here, this didn't look that low because you cut your portfolio in half. But my point is, you have to be able to buy low, and maybe we're gonna have a sustained bull market and all that, and whatever. I mean, but going back from, well, at least for First Majestic, I mean it what looks to, at least since the top 2011, you can see that there's been this pattern of like, I mean, in terms of time, if this was the top, this was like 4 years of bear market, or almost 5. The rally came within 8 months. So 4 or 5 year bear market, fat rally, came and went in just 8 months. Then a 2-3 year bear market, and then it started to rip a bit. COVID flash crash which scrambled things, but then it ripped in Feb. So basically a year of rising prices. But if we count this as the low, it took this amount of time to reach the final low, and believe me, nobody knew the low was in when it was in. And obviously the time from low to the next top was much shorter. So we have a lot of time in the junior sector, at least since the 2011 top. The bear markets, the corrections are much longer than the bull markets, or bull legs. So what does that mean? Well, it means it's a very frustrating sector, right? Because you spend a lot more time getting pissed in the face than popping the champagne corks. But that also comes with the benefit that you have so much time to average down. Do your due diligence, learn up about investing, learn up on mining, whatever. So down here, and no stock is gonna bottom at the exact same time, but like around this time here, increasingly so, the cheapness of your portfolio should go up and up and up as the sector gets cheaper and cheaper, and as you learn more and all that, and whatever, read up on risk reward and let's say free optionality and yada yada. So the risk reward in your portfolio should be absolutely bonkers at the lows here, getting increasingly so as probably the paper losses pile up. And then boom. I mean, I remember here, yeah, so my portfolio did 500% in 8 months here. So did I take a beating, minus 50%? Yes. Did I know anything? Almost nothing. I almost knew nothing about mining except that I could see that this sector was absolutely decimated, much closer to a low than a top. So I just bought and bought and bought until the low was in. I had no idea the low was in, and I probably added as fast as I could to the upside. I probably bought the exact high as well, and then rinse and repeat. But the thing is that I make more in the bull legs than I lose in the bear legs, etc. And I'm proactive in the sense that I put in more money. So maybe let's say theoretically I would be down 70%, but I've averaged down. So I'm only down 50% going from this top. Okay, cut my portfolio in half again, boom, up 443%, make money again. Okay, it goes down, but I average down even more, boom. And of course, with some stock picking and all that, because I don't necessarily like trading sardines that always, retrace to the exact same low and to the same high, but that's where the, alpha or performance come from, let's say. But I don't know what my returns would have been if I couldn't pick up the good cases, if I couldn't average down in them. So my point is, it's absolutely not buying high that kills anyone. That's just copium. That's an excuse. I mean, this wasn't even high, but I still got my portfolio cut in half, and that turned out to be not really a problem. And I should have, which I did. I was just buying hand over fist. I was buying hand over fist here. I've been buying hand over fist here. I've been buying high as well. But the thing is, like we can see, this high, it went from up here to down here in what? 2 months. And then it's like long grind. Plenty of opportunity to. So if I just did monthly purchases, you're gonna be buying low a lot more of the time than you're buying high. So I mean, if nothing else, if even in a trading sardine, at the next high, if you do monthly buying, I mean, you should kind of, the gains should be increasing in a sense, because you lower your average in every cycle in a sense. And then of course, what's even better, buy even more down here. Buy more aggressive the lower it goes, yada yada. Maybe buy less aggressive the higher it goes. But I stick to stock picking. I don't really care. I mean, First Majestic looks low and all that, but I don't know much about First Majestic. I do think that it's gonna. I mean, if I had to bet, I think the next big move is up, but I don't know what the edge is. I mean, how cheap is First Majestic right now? I don't know. I know juniors that I think are just obscenely cheap. I don't like to pay fair price, let's put it like that. Yeah, I mean, best time to buy is when 90% of comments are negative, also good indicators. Opportunity cost, I mean, I could spend an hour on opportunity cost. I could have just bought Nasdaq. I heard a lot of that last year, especially. Nobody cares about this sector anymore. Hear that even today. This time is different. But as we can see, we're higher than we were 2024. On average, the major miners are certainly higher. So everyone who thought it was different this time was wrong again, and they're gonna forever be wrong, probably as long as we live, at least. I would bet, but that's never going to change. Never going to change. That's the whole reason why you have sectors like this. Do you think the market knew that this was going to come down here? Obviously not. In that case, it would be already up here if it knew it was going to trade at this price. Instead of being down here, it would be up there. So it's mind-numbing how forgetful people are, and just how many. Regardless, you can play out this pattern a million years. At every low, everybody's gonna do the same thing. Everybody gonna think that it's different this time, and this is never gonna go up. All of a sudden, it goes up a lot, and all of a sudden, it's never gonna go down again, and then it goes down a lot. And here, this sector is dead. Nobody cares about the sector anymore. Boom, up, and rinse and repeat. So and opportunity cost. I constantly hear about opportunity cost. The funny thing is, like, okay, opportunity cost. When you look at how people, this is the irony of it. It's like maybe this isn't First Majestic isn't a good example, but it's like, okay, let's say nobody knows this. Of course, we don't know exactly where First Majestic is going to trade, but let's say it's going to trade up here in 2 years. What the hell can I? In 2 years. Okay? Down here, people are talking about opportunity cost. Why? Because the recent trend was like this. What is the opportunity cost? Is what has happened opportunity cost? Or is what's gonna happen the opportunity cost? I did a slide about this, but I couldn't find it. This is what most people call opportunity cost. They handle or use opportunity cost. The way they used it is to look at a extended period of time that has already happened. That's what they think opportunity cost is. In a sense, yes, I get it. You looked at, hey, if I could go back in time and I wouldn't buy this, it wouldn't have gone down in my portfolio. Yes. But that's not how opportunity cost works. That is not opportunity cost. Everything is clear in hindsight. The only way knowing the obvious would be worth something in hindsight if you had a time machine. Opportunity cost is not a period of time. Opportunity cost is at any given second. All available assets you can buy for your money, let's say. What has the best risk-adjusted return? I mean, I guess in the textbook that's basically how it is. Because nobody knows the future, and the hindsight is worthless. We can't go back in time. And again, it's like, okay, if we think about it, this should you be talking about high opportunity cost, and in what way? Because if this is going to happen, it's very high opportunity cost not to be in First Majestic at this point, for example. Because you're going to make 358% in 2 years. But everybody complains about this as the opportunity cost. The past is absolutely worthless. I hear people complain about, I shouldn't have been this and that. So okay, so what they're saying, I mean, that's belly aching, of course, but it's like, what do you expect? Oh, next time I will never be in something that goes down. So in people's mind, why they bitch is because they can't just be part of this. And when it goes down, they bitch about the opportunity cost, because it's so easy to just be in the next thing that goes like this. And then, of course, again, you don't want to be in any correction in anything unless you start bitching about, or you're gonna start bitching about that. So in people's minds, this is what it sounds like is their measure of success. If their portfolio is not up 1,725%, and that's just on a, what's that? Let's say 1.5 years basis. Okay, so that's the compounding apparently people expect. And then of course, over the next 1.5 year period, this is also the same goal they have, that never again, don't be in any stock or any asset that ever corrects, because then you're gonna be down on the down because the fact that you had, quote, opportunity cost. So yeah, so within, I mean, how 10,000, if you start with $10,000, I don't have my compounding calculator, but you within whatever 4.5 years, you might be, I don't know how much money you would have. Let's just do the quick calculator instead. You start with $10,000 times 18, 1.5 years. Okay, 180 times 18, so that's a 3-year time. Okay, so then 18. So yeah, your 10,000, you expect it to be $58 million in 4.5 years. And 1.5 years later, 1 billion. 1.5 years later, 19 billion. So what's that? 7.5 years, you expect to go from, let's say, $10,000 to almost $19 billion. The expectations people have are absolutely absurd. As soon as they're in a downtrend, even if it's like 3 months or 4 months or whatever, they start talking about the opportunity cost of owning that stock. It's just absolutely crazy, regardless of how high it went. It's like you can pick whatever. Take Snowline. Snowline is obviously have been a big fat success, and I guarantee you that people are bitching about opportunity cost anytime this is not going higher. I saw one complain, maybe a troll complain in the room of Magna Mining yesterday, and that's after Magna haven't made a new all-time high in 2 weeks. It is unbelievable how clueless people are, and they have no idea, and that's obviously why they're never gonna make any money. Their impatience is so extreme, it's not even, it feels surreal. Imagine you've been, let's say, in Snowline, goes up here, and I remember, I think people were bitching about that as well. So let's say you start bitching about the performance of Snowline here, like what, 1-2 weeks after the all-time high. It's absolute. So what they're saying is that again, this is not okay. This is okay. If this happens, fine, okay, that's, you can live with it. If this happens, you're gonna start whining about how the stock is performing. Which then, by that again, with that measure stick, or however one would like to call it, this is their expectations for their portfolio. So by 2025, today, 2 years later, it would be, I don't know, where are we there? Okay, I'm just gonna, okay, let's see where it, this is acceptable to them. This is not acceptable. after having a run like that. So yeah, if I hope you get my point. It's like people who can't, most of the people who don't even beat an index are complaining about opportunity cost and indirectly suggesting that this is the return they are after for any stock they are in, and thus their portfolio. It's absolutely insane. I mean, when you think about it, like the worst investors, or if you believe their own words, let's say, they are chasing returns that would make Warren Buffett blush. This is how much? Yeah, 1,381% over a 2-year period. So kind of like, yeah, the one First Majestic we just looked at. My aim, it's like if you can compound at 20% per year over a 15-year period, that's great returns. 20% is like twice what the market averages on a long-term basis. You're doubling, you're not outperforming, you're crushing the market at 20% per year. And the people who can't even do that, they are the ones expecting 1,381% every 2 years. Do you think they bought any low here? If you bitch about the stock price here, for example, how are you going to feel if you see this? When you should be buying if this is an intact case. And you should be buying maybe hand over fist, increasingly so. Do you think they are? No. Of course not. Because they're talking about opportunity cost and that this stock is not performing and yada yada yada. And the worse results they have, the greedier they are going to be. It's like in poker. When you lose money, you go on tilt and you want to make it back even quicker. Then you really won't be buying any intact cases that just sold off for whatever lame reason. No, then they are probably going to go into crypto. Because that's what I see quite a few people who I don't think were buying the lows in the junior sector. And now they probably don't want to get in because now they have regret. So instead they're going for whatever Bitcoin treasury companies and all that. And what would they be? Some of the hottest things around. Again, the people only care about stuff that's going kind of exponential. And that's a huge advantage for anybody who can figure out what might go exponential one day, like this entire sector, and buy it when it's absolutely going unexponential. So in a sense, the biggest edge in my opinion, the easiest edge is common sense, understanding market psychology, cycles and sentiment, and just abusing Mr. Market day in and day out, knowing what he's gonna do before he's gonna do it. Why do I keep buying lows in this sector? Why do I do all my copium videos? I haven't needed to do them recently, which says something about sentiment is getting better. Okay, these are not juniors, but anyway, so it's like why did I started buying here just because it was cheap. I bought all the way down here. Why? Because I know it's gonna go up one day. I know the sector is gonna go up one day. Why did I buy all the way down here, increasingly so down here? Because I knew this was gonna happen. It's not rocket science. I mean, it's so simple. It's disturbing. It's not even that fun in a sense, because it's so predictable. This is gonna probably happen for as long as we at least are alive. And that's why are they called cyclical sectors? Because they are cyclical. But why are they cyclical? Because everybody believes that this time they're not gonna be cyclical. Why is that? Because human nature. Again, it's like You don't need rocket science to like, oh, hey, I found a cyclical sector that's cheapest in 40 years. Should I be buying? What are the risks? It's going to go down forever. So basically, we're not going to have a civilization. Okay, well, that's the worst case scenario. And then, of course, it doesn't matter what you own. Sure as shit, crypto is not going to be around if the world ends. But if the civilization doesn't end, we're going to need more commodities and every mine is going to run out one day. I think I'll take that bet. That has proven to be right forever. Or since the dawn of financial markets or human civilization. That's why I keep posting so much, not even company specific, but just so much stuff like this and whatever. And I know it sounds arrogant, but I'm trying to snap people out of it. It's like, don't overthink. I mean, it's like Warren Buffett said himself, you don't need to be a rocket scientist. If you have an IQ, I don't remember what they said, maybe 130, you probably have 30% IQ to spare. You have 30 IQ to spare. It's like you don't need it. Because this is not rocket science. I mean, this sector is probably a lot dumber than the overall sector. Because it is this cyclical. And still everybody forgets it is cyclical at every low and top. And I mean, just look at the trading in a lot of stocks. Like everybody's at lows, people are only talking about the risks. At highs, people are only talking about the upside. In between, you have everybody's pricing in what the next news release. If people think the next news release is going to be bad, there's no price too low to sell. If they think it's going to be good, there's no price too high to buy. Everybody's looking at, pricing in one asset. Everybody's looking maximum 3 months ahead. I mean, it's just, this sector is, and that's also company specific. So it's like, this sector as it is doesn't need rocket science. It's that dumb. It's that cyclical. Then we're looking at case by case basis. And you have a bunch of different opportunities to exploit. Again, how short-sighted the market is when it comes to news, how tunnel visioned it is when it comes to pricing in whatever assets and stuff. And I forgot, I did a video with like 3 different ways to exploit the junior sector, but I hope you get my point. So it's like, I think a good sign is when you stop taking anything personally. And why, let's say, I have some juniors that, let's say they're up 100%. Why am I not cheering? Well, I liked what Castemato told Mike Tyson after he had his, I don't know if it was his first win or whatever, but he cheered like crazy and cussed like, why are you cheering? This is what you've been training for. So like, the more you see people cheer about any particular stock going up, let's say, I'm not saying I'm never gonna do that, by the way. That's when, especially not if there's good news. Some company made a discovery, then I would be over the moon because all of a sudden the case changed a lot. But like just paper gains and all that, it's like, I mean, if you average down, let's say here, and now it's up here, or you average down, down here and down. Should you really be that surprised that you're gonna see green one day? Should you cheer like, oh, this was a huge surprise, I never would have dreamed of seeing green in my portfolio? In a cyclical sector, if you're buying like 40-year undervalued levels, most undervalued levels in 40 years, should you actually have the nerve to be surprised that you're gonna make money? If you are, do you really understand why you shouldn't be? And I keep saying, it's like, if you take paper gains personally, you're gonna take paper losses personally. So if you share the paper wins, you have to mourn the paper losses. That's just emotional. You're raking yourself over the coals. Plus, if we're like, okay, let's say juniors are still down here, for example. Let's look at SILJ. Might be, I'm not going to say a good proxy, but hey, why not? It has a pretty cool looking chart at least. So let's say we're looking at this and we think this is like the juniors, like not even back to the 2021 levels, like fair. A lot of juniors aren't, but we're looking at like, okay, let's say they're super cheap, yada yada, and we think, okay, they're so undervalued they could go up hundreds of percent and not really be super overvalued, and not anywhere close to euphoric valuations, let's say. So you have you buy, you average down, and let's say you're up 30% here. Should you be sharing this? Is this what, if you're sharing this, is this what you're playing for? Were you surprised that you got a 30% bump, or are you like immediately? I mean, I try to find juniors that I think could go up several hundreds of percent. And in the high risk cases, thousands of percent if things work out. So let's say I have maybe not the best chart, but let's say I have a span where it's like, okay, this is average what I think the average undervaluation is gonna turn out to provide in terms of rewards in the future. Should I be sharing, or okay, let's put it down here. So 353. Should I be sharing 30% returns? Why am I sharing? Do I think it's over? It says something in that case. Also, I mean that's the thing. Maybe it's because I've been a poker player, or whatever, and I like to figure out how, I guess, people work, how they think. In a sense, because then you can use that to obviously figure out how the Mr. Market thinks, the marginal investor. But if you're overly sharing this, doesn't that kind of suggest that this is not what you foresee happening? If you think you're going to win a marathon and you're in the lead in the first 300 meters of a marathon, is that a reason to celebrate? If somebody cheers after running 300 meters, what does that suggest about what he sees considers a marathon to be in terms of like distance run? If he's cheering after 300 meters, or whatever, a hockey game, a football game, soccer game, somebody scores the first goal in the first 2 minutes of the first period. Is that game over? Have they won already? Are you gonna leave the game because, well, it's already over? It's like, this is wrapped. No. So it's like my expectations. I think we could be again. I think the market, the juniors bottomed in like 2024 last year. But I think, personally, I think there's heck of a lot of room to the upside. Certainly, I think that's the case with my juniors. Even the ones I would consider like medium to low risk ones, I think could do a few 100%. Especially at today's gold price without looking expensive. So when you have that kind of idea, goal, etc., are you going to be sharing about 10% up days? No, I couldn't care less about 10% up days. But if you do share about that, that also signals that you're probably not going to be along for a bull run. Because if you think a 10% bump is that much, that says about, I mean, then your time horizon or expectations might be like, you're unsure if you think it's even going to ever go up. So if you see it's up 10%, it's like, whoa, yes, nice. And you're like sharing like something has happened. That says something about your conviction. Whereas if you have someone who's like, knows the case super well, had conviction, he believes like 200% should be easy. If that one stock goes up 10%, or do you think he's going to be in the forum cheering about making a big deal out of a 10% bump? No, he probably thinks that's a rounding error. And he knows that it could go down as much the next day without it being worth anything for his overall longer term case, because he's looking at, again, let's say 200 to 500% over 2 to 3, 4 years. So it's just noise. In the meantime, it's just noise. Think about it. And that's why it's like you can, I mean, what some people write in form, you can kind of tell what their expectations are, their conviction, what their kind of threshold for celebration is, and you have an idea what, how well they probably have done in markets. And especially if we have a super volatile sector that could go up hundreds of percent in like 8 months, and people are sharing like 10-20% rips, that says something about how probably little they know about the sector they are in. And or I mean, what's maybe more common is the usual, because most people again complain about opportunity cost as soon as there is a correction, so they only want to be in stuff that's always going up. And what's more common probably is just people kind of call it pumping when something goes up, because they want it to go up a bit more so they can quickly have a profit that they almost never have, and then they can sell into that, let's say. Sort of a pump and dumps, like everything is short term. You just want to make 50% as soon as possible, then you sell out of that position and you're very happy about it. I think they're just playing small. My point is, I guess, that I think let's pull up Snowline again. If you factor in rational expectations, yada yada, it's like if personally, I'm hoping, I'm aiming for 50% per year, or let's say a doubling every 2 years, etc. So it's like, this is my opinion, the signal. If you're on board, and if this just keeps going up, yada yada, you're gonna be super happy. Returns are gonna be spectacular over next few years, and especially from whatever, let's say this is out in 27 or whatever. It's like, hey, if you did 824% in 5 years, that's absolutely marvelous, super compounding. While most people are just busy trying to, get these in and then not be in any stock. They just try to get this in. And of course, that's also gonna get, like most people, that's gonna get them to buy near the tops, because that's the only time it looks like the quick profits are also imminent. Whereas when something goes down, they think it's the opposite. The quick, it's expected to be quick future losses at the lows, right? And then they really don't want to be in. But if you if you just hodled or did some value shufflings, like, okay, this is 396%, this is 107, that's a big difference just buying low in an intact case, right? 175, that's an extra 100%. So it constantly changes with price, but in an intact story, you don't need, that's the thing, was like, even a 10 bagger, I've showed Lundin Gold, I've showed Snowline, yada yada, most of the time, these future 10, 20 baggers, they do not put in a higher high. It topped here, took until here for it to go up again, then it retraced to the same high, then it got going, but it didn't make really a new net gain until here, and then it started consolidating again. So even the 10 to 20 baggers, you're gonna feel like they're going absolutely nowhere most of the time, because over 90% of the time they're not gonna be making new net highs. Do you think any of these super impatient people are ever going to be on board for a 10 bagger? Absolutely not. When you read somebody's like, oh, I made, I was in whatever stock it was, I'm up 10 to 15 times or something. It always pretty much is that, well, they bought it years ago and held it. But if you, again, it's like, just think of it from what is everybody focused on almost in every channel? In every stock channel on CEO.ca. What are people bitching about? What are people focused about? They are focused on the short-term direction of the stock. So we know that everybody and their mother is focused on the short-term direction of the stock. So their time frame is this much, basically, this long. They're here. They're thinking of what the stock's going to be within this time frame. Whereas like HODL, most HODL portfolio approaches like, oh, I think this stock is probably going to be higher over the next 1, 2, 3 years, and it could be hundreds of percent higher. Daily movements, I don't give a shit. I care about an intact case that I'm buying on the cheap or holding on the cheap. So remember that. Like, look at what everybody's focused on. That's typically when they think the stock is going to go up, or if it is going to go up in the short term. So if everybody's focused on that and almost nobody beats an index, do you think you should be focused on that? Or should you maybe use the fact that in a downtrend, everybody thinks it's going to go down. That's why they're selling at the lows. And buy that. And if you're, I'm certainly not a good seller. But if everybody thinks it's going to go up here, well, okay. That's more pure contrarian. That's why I don't like to see myself as a contrarian. I just like to buy what's cheap. But you can certainly understand why people are selling. More are selling and not buying as it goes cheaper, because they are guessing that the stock is gonna. If this has happened, if this has happened, if the weather today and yesterday was down, of course they're gonna think that tomorrow's down. Then it goes up, and here they might change their mind because all of a sudden now the weather's been good, so they think it's going to be sunny tomorrow. That's when they're buying. That's when they're buying. Because again, by definition that has to be true, because if you look what everybody's focused on is where they think the stock is going to go in the short term. And look at silver. Jesus, silver might be the best example. Let's see here. Oh my God, this is turning into a long video. Silver is probably the best example because this is so volatile, so choppy. Every single freaking, here people think it's going to go up, here people think it's going to go down. Every single top and bottom here, vast majority of people thought it would continue. And if 95% of people buy only when they think something is going to go up, they're going to be buying here, increasingly so. And down here, they're going to be selling increasingly so. That's why nobody makes any money. Because the hunger for these absurdly high compounding rates, never been a correction and all that, only being stuff you think is going to go up in the short term. If nobody's making any money and everybody's focused on that, what does that say about that strategy? But if you have some kind of value, sense of value, you're just gonna, whatever, look at, oh no, I don't have the Snowline chart, but it's like, okay, if you think this is value, this is the value curve. Preferably, you'll buy any time the share price is under the value. The more it extends from said value, the more bullish you would get by definition, because if you think it's worth X and it drops to 0.7x to 0.5x, this is a cheaper buy. And then you get higher returns. Cheaper gets higher returns. Cheaper gets higher returns. That's what I'm only for. That's my simple, I don't know, I don't try to predict share price movements at all, basically, in the short term, because I'm most of the time wrong. I'm most of the time wrong on where metals are going in the short term. I've been kind of expecting gold to, have a big correction ever since $2,300 gold. Thankfully, I didn't. I did not let that affect me. I just kept buying assets that I thought were very undervalued, and hold as long as they're undervalued. And lo and behold, sooner or later, stuff starts to climb to its intrinsic value. And sentiment is a major part of that. Anyway, now I talked so long. But I hope people, in my opinion, success is, that's why I also don't like to be a trader, and I've said this before. At least, a day trader or a very active trader, because if I'm thinking of quality of life and all that, if I were a day trader, I would only be making money, potentially making money, if I were stuck at my computer trading. That's active work. When you own a stock and you have whatever, a longer time horizon, you're buying the labor of the people in that company and all that. If you hold a stock for a year and you think they have a whatever good asset, good management team, that company works for you for a year. They worked for your shares, your ownership. Somebody worked a year to create value. You bought that labor, their time. So they're working for you. Day trading is like, I hold a stock for, an hour. Nobody's working for you, you're just flipping paper. Plus it frees up a lot of your spare time. Or you get a lot of free time in the sense. Funny thing, when I'm on quote vacation or conference, it's like typically my portfolio does better when I'm away from it. I'm not really that active anyway, but it's probably just happenstance, but still. It's like, okay, all of a sudden, my portfolio's revalued a bit, so I get paid for my work of identifying cheap companies, and it's not like I got paid in full because I think they have a long way to go, but it's just a day trader can't just, I'm going on a vacation for for a month, or conferences for a month, and I don't trade anything. You're making nothing, obviously. You're not losing either. But it's like, I don't see how a somewhat hodl approach can't be the best quality of life balance. But of course, again, most people have way too unrealistic expectations of what the returns they want to have. Most people act in the market like nothing except 1,500% every 1.5 years. Anything less than that is, gets an F. That's how they actually operate. That's kind of what they're suggesting their return goals are. 1,500% every 1.5 years. Despite the fact that if you would average 100% over every 2 years, you would be a world beater. You would be averaging compounding at 41%. But that is way too low for all those people losing money to care about. And the more they lose, the quicker they want returns, which will get them to find hotter and hotter sectors to be in, where the gains are happening right now. That's why that's what I done a lot of videos talking about, breaking the cycle of always buying hot, selling, always buying up here when this sector is quote working and people are quote making money. Sell down here when it's not working, people are losing money. Find another sector that's up here and just compound the same mistake all over again. And the worse the more losses they pile up, the worse the portfolio, the hotter stuff they're gonna be looking at. That's basically like going on tilt in poker. You're gonna jump up in stakes. You're gonna be more aggressive. You're gonna take more risk because you have to make back the money quicker in your mind, because it hurts you to have a poor return. The best thing is like, okay, so what? Everybody's probably, or most people start off buying anything high. Sure, but that's like, cost of tuition. It's like Rick Rule said. He mistook a bull market for brains. He made a shit ton of money, then I think he said he was even in debt at the next bear market. So even Rick Rule, fortunate enough to buy low, but didn't really know what he was doing. It topped. He had whatever his net worth was up here in his first bull market top. Gave everything back, started from zero, and then came back. I mean, you would be better off than Rick Rule in that case if you're only down 80%. Because last I checked, Rick Rule has done fine since. But you have to break that cycle. Doesn't matter. It's like you can start from whatever. Start from scratch. Everybody has their own journey. If you started with 10,000 today, if you just picked up, found a good investing strategy that worked for your temperament, yada yada yada, stopped selling goddamn lows every time, had some risk management, whatever. Let's say you could compound 40% from these levels over the next 2 years, and then maybe as you get better and better and better because you learn, so the higher price the sector is, yes, the easier returns are going down, but you've learned as well, so maybe you can offset that, or maybe, who knows, maybe we'll be up 300% in 2 years instead, and from then on it's going to get much harder, but hey, we're up 300% and then we've learned a lot as well, so maybe we can average 20%, or just minus 30% or whatever until the next low, or even minus 50%, and then up 300% again. But we have to break that cycle, and for the love of God, don't give the market too much credit. If you just look at how this sector trades, every single bottom and every single top is like a black swan event. The market had absolutely zero. It was betting 1,000,000 times against an idea that SILJs would be up here a year later. The market was not even the realm of possibilities down here that SILJ would be up here 8 months later. And here there was no chance in hell, thought the market, that this would happen. And no chance in hell up here that this would happen, etc., etc. So it's like, how much credit can you give the market? It's so wrong at lows and highs that it's not even funny. It's not even close to being remotely predictable. Because obviously, if yeah, I mean, who would be selling down here if they knew, SILJ would be trading up here just a year later? That's what, 5 years worth of returns, much more in the overall market. Yeah, so it's whatever, many times what anybody would expect to make in a stock market in 1 year. Do you think anybody thought that was going to happen? Absolutely not. So it's like, my stance is like, the market is always wrong. I think that suits at least me better to think the market's wrong, because if I'm right, I might make a lot of money. If I'm wrong, I can only lose 100% in any one case. So I kind of have to bet on myself or this sector overall when it goes into the lows, because my odds, I'm getting so good odds for something that has never happened before, meaning that the sector goes down forever. Never ever happened. So if it's starting to price in that, there's a 90% chance that this sector is gonna go down forever, it's like, isn't that the most obvious no-brainer bet you could ever take? Somebody gives you a bet like, hey, somebody wants to take a bet here that's like pricing in 90% chance of, or risk of, a cyclical sector stopping cyclical for the first time in human history. You want to bet against that? The worst you can lose is 100%. The best you can make is 300%. That's a pretty good bet. You're betting that this time won't be different, and if you are right, you're gonna make 300% in 1 year or something like that. In this example, yeah. Anyway, long rant. Consider me biased if I talked about any companies. Assume I own them. I have sponsored companies, etc. So twice biased in that case. Not investing advice. I'm biased. Don't invest money you cannot afford to lose. I don't share your profits or losses. I have no idea what I'm gonna make on exactly one stock. I have no idea which I'm gonna lose on, etc., etc. Always assume I might buy or sell at any point in time. Always do your own due diligence. Never, yeah, you can't trade conviction and all that. Yeah. Anyway, hope you get something of this 2-hour rant. Thanks for listening. Bye, guys.